Hello and welcome everyone. Today our discussion is on a topic which is tested for sure in every exam of SBL. Now, this aspect is critical for you even as a working professional, but more so right now from an academic examination oriented point of view. It makes a lot of sense to work on this concept, which is basically understanding stakeholders. Now, in every SBL paper, you will have in the pre-scene information, company, industry overview and then company overview. In the industry overview part, you will often have information about competitors, employees, government authorities. You will have information about customers and suppliers and all of these players in the company info section. And a key part of your analysis of the pre-seen material, a key part of your ability to answer the question on stakeholders in the exam will require you to basically do a thorough application of the Mendelow's matrix. So this discussion is super critical from an examination point of view. While SBL is not a subject, where you have to learn things by heart, but this is one topic where I would advise you to at least learn the application or understand the application of Mendelow's matrix in depth. Now, in case of corporate governance discussion, which of course is going to branch out separately, I want to specifically focus on stakeholders. Now, who are stakeholders? Stakeholders are individuals or people or companies, basically anyone who is affected by what the company is doing. Somebody who has an interest in the company, somebody who is affected by what the company is doing, somebody whose own financial fortunes or success depend upon the activities and actions that have been undertaken by the company. That person is the stakeholder. Now, if I am, let's talk about MACD in India. Now, MACD has so many customers who are ardent fans of the company, and their day wouldn't start if they don't get a MACD burger when they want. So, customers are stakeholders. So, and because MACD produces in bulk and it has centers and outlets in almost so many big cities of the country, naturally they create or they generate a lot of business for the existing suppliers in the market of different vegetables, agricultural produce, and raw material and packing material. So, all these suppliers also depend upon MACD for their own financial success. So, suppliers are also a critical group that is impacted by what the company is doing. The shareholders of the company naturally have a lot of dependence on the company. Their growth of their wealth, growth of the company, growth of these individuals is directly impacted by how well the company is growing. Their financial fortunes depend upon the company. Somebody who has given a loan to the company is keenly interested in knowing whether the company is in a solvent position and whether it is in a position to service its debts or not. So, if there is anyone who is praying for your success, is if there is someone who is praying for your financial success, it has to be the lenders and the creditors of the company. The government body is no exception. The government depends upon you for its tax revenue, and the government can function only because you are paying tax revenue to the government. So that again means that government also is a key stakeholder because the financial fortunes of the government also depend upon your success. And it is this group of individuals and companies and government and all of that collectively known as stakeholders whom we are going to analyze in our current discussion. In the stakeholder ecosystem, there are three ingredients that I would primarily want to talk about. The first one, capitalist institutions, then the CSR element, and then, of course, the environmental factors. Shareholders, managers, employees, customers, and suppliers form the traditional business core. So, people who are directly dependent upon the company, like the shareholders of the company, the managers who are in a decision making role, the employees whose livelihood and day to day existence depends upon the smooth functioning of the company, the customers who depend on the company for goods and services, and the suppliers who supply raw material and other ingredients to the company. All of these together form one set of stakeholders. Then, of course, there are those elements for whom you do not actively work, but they expect certain outcome from you. Like the government expects you to pay taxes on time. The local community has a viewpoint that if you are using the resources that belong to the community, if you are thriving and surviving in the community and in that particular ecosystem, then it is your responsibility to give back to that economy, to give back to that ecosystem. And that is basically your That is the CSR element. I'm not saying you are doing anything for them for free, but the point is that these people, like customers, have paid to purchase a commodity from you. Customers have paid to acquire a service from you. Local community has not paid you anything. But the very fact that you survive and thrive in an ecosystem in the local community, and you are using the resources that belong to the community, it is but your moral responsibility to pay back to the community. It represents your broader responsibility. And then, of course, environmental factors. Whatever you do should keep in consideration the fact that your production activity will lead to pollution, and that pollution can have a damaging effect on the environment. Whatever you do severely adversely impacts the environment around you, and hence you have to be mindful of the consequences of your actions. So when I look at the first ingredient of the stakeholder ecosystem, when I say capitalist institutions, these are those people who have some sort of a direct financial give and take with the company. The CSR elements are those who don't have a direct financial give and take, but who impact the company and who are impacted by the company in exchange. And environmental factors is, of course, your overall responsibility with respect to the environment. Now, stakeholder theory and agency theory are different from each other. How exactly? Agency theory focuses only on directors and the shareholders. Shareholders are the owners of the company who have contributed the money, and the directors are running the company on behalf of the shareholders. This is the only relationship between the two. The primary goal of the company with respect to the shareholders is maximization of shareholders wealth, and directors are expected to help the company when it comes to maximization of shareholder wealth. They have to put the interests of the company first and their own interests come secondary. That is the agency theory. Stakeholder theory is not just only about directors and shareholders, but it is about the broader stakeholder group, which includes everyone from the customer supplier to the government to the local authorities to the environmental pressure groups to everyone. And the goal is to maximize the company value in a holistic manner, not just the maximization of shareholder wealth, which you can count in numerical monetary terms, but maximization of overall company value, development of the overall relationship network, and comprehensive stakeholder engagement, making sure that all the stakeholders' requirements and demands are heard of, and you work in a manner to fulfill their requirements and at the same time not compromising on the needs of the other stakeholders in the ecosystem. Agency theory has a narrow focus because it works only with respect to directors and shareholders. On the other hand, the stakeholder theory has a broader perspective because it looks at giving a holistic growth to the company and honoring the requirements and demands of the individual stakeholders as well. Now, let's evaluate the boardroom impact and strategic value. The integration of stakeholder theory into corporate governance has transformed boardroom decision making. Directors can no longer afford to ignore stakeholder interest when maximizing shareholder wealth. High level of stakeholder dialogue and engagement have become indicators of quality management, with investors increasingly viewing stakeholder engagement as a measure of effective leadership. Think of a company like, say, Nykaa. Now, Nykaa is into cosmetics and these cosmetic products. Ultimately, the objective till now historically was always maximization of shareholder wealth. But Nykaa also needs to keep in mind that a lot of its customers right now could be those who are vegan or could be individuals who probably prefer cruelty-free cosmetic products. Now, just because certain types of animal fat is available easily, and that animal fat can lead to quicker production of cosmetics, the company cannot continue to focus only on using animal output or animal fat in manufacturing of cosmetic products. Even if it means that producing organic or cruelty free products might involve a larger cost to the company, if there is a stakeholder group, if there is a customer group that emphasizes on the usage of cruelty free products, then the company will have to make an effort, maybe spend additional cost to fulfill the requirements of these customers. The idea of maximization of shareholder wealth cannot come at the cost of harming the interest of the individual stakeholders. Think about it. Today we are talking again, let's talk about cosmetics, or let's talk about maximization of shareholder wealth. Now, usage of chemicals or usage of harmful chemicals to increase the longevity of the product, but which could have a negative or an adverse impact on the skin of the consumers in the long run, or which could cause, certain diseases in the long run, is shunned upon, because only to maximize shareholder wealth, you are using low quality material, and that is harming the interest of the physical health of the consumers in the long run. Or let's talk about responsible marketing. Your objective is maximization of shareholder wealth. I agree. But at the same time, you should be aware of the fact that you cannot do any misleading advertisements or promote any misleading marketing information in order to lure customers, fool them into buying your products or service, ultimately leading to a large scale customer dissatisfaction. I mean, it happens today in most of the edtech companies. I need not mention a company in specific, but a lot of false advertisements are given out in the nature of, you complete your ACCA and you will get a job of 30 lakh rupees, or you will get a job in United Kingdom, or some advertisement of this sort, or you will get a guaranteed internship of so and so amount. Now my point is, you are luring the customers with a false promise. The customers are placing their faith in you, they are giving you a lump sum of money, and the course probably is not capable of delivering that value to the end users. Now, because you wanted to maximize the company wealth, you probably did not make an adequate disclosure of all terms and conditions to the students. You pitched them improbable ideas or impossible ideas. You got their admission, and now you are not honoring that promise. You are fulfilling the impact of, maximization of shareholders wealth. You are achieving that, but it is coming at the cost of harming the interests of the individual students, which in my opinion is quite unethical. So the discussion regarding stakeholder engagement and management of stakeholder expectations has now reached the boardrooms, and now you cannot think only about the wealth or the profitability, but you have to think about it holistically. Maybe if you know that the person is not the right fit for doing ACCA, maybe you shouldn't sell that course to him. If a person says that I cannot speak in English, maybe you should not sell that course to him, because he will find himself completely lost if he is not familiar or comfortable with the language. You would have made your money, but that student would be out of 2,50,000 rupees from his pocket. And that is one of the worst things you could do to a trusting individual. Now, there are two approaches to stakeholder management. One is an instrumental approach, that in the overall objective of, in a quest to achieve the overall objective of maximization of shareholder wealth, stakeholders benefit as a side effect. For example, you want your company to grow, you want your profitability to increase, you want wealth maximization. So for that, this can only come out of a positive word of mouth. So you focus on the good customer experience, so that these happy customers will give a positive word of mouth, or these happy customers would post good reviews on Google, on LinkedIn, on other social media platforms, and you will benefit from that. Your objective was not to help the stakeholders. Your objective was not to help the individual customers. You did not care for their well-being, but you wanted them to give a positive review or a positive feedback for your product. So you went out of your way to help them. It was a completely functional, business-driven approach. Nothing wrong with it. Okay, stakeholder management serves as a strategic tool for wealth maximization. It is a means to achieve the final end. So the reason why you are keeping stakeholders happy, the reason why a company is, an educational institute is keeping the students happy, is only to garner more positive reviews from them. Is it wrong? Maybe for some thinkers, but ultimately, if it is helping the organization achieve its end, then a lot of individuals do not consider this to be problematic in any way. And the normative or the intrinsic approach is, the morally upright approach. Okay, where you go beyond the legal requirements given under different laws in order to ensure that your stakeholders are happy and satisfied, that they value their association with the organization. You don't fulfill the responsibilities, you don't fulfill just those responsibilities which are enshrined in the law. For example, when it comes to consumer protection, okay, the Consumer Protection Act makes it mandatory, or the Legal Metrology Act makes it mandatory to list the ingredients, their quantitative proportion, and allergens, and all of that when it comes to sale of food products. Okay. But you go above and beyond, and in your stores you do an assessment of the customer, and then you recommend a particular food product or a particular protein powder to him. See, making adequate disclosures on the box of the protein powder is the legal requirement. But if you know, if you look at a person, you do his BMI assessment, you look at, his medical reports, and then you advise him what is the right protein powder for him, then you are definitely fulfilling the requirement of disclosure of the ingredients on the label. But you are going above and beyond, you are taking the overall holistic well-being of the customer in mind, and then suggesting the best protein powder for him, not necessarily the protein powder with the highest price. So here you are acting in an appropriate manner which is morally correct. That is the normative or the intrinsic approach. So here you are going beyond the bare minimum expectation, and you are trying to deliver more for your individual consumers. You are taking their holistic well-being also into mind. Now let's understand stakeholder risk. What is business risk? The risk that a business will not achieve its objective. I want to have 100 crore company, and the risk that I will not be able to achieve that particular objective of mine is business risk. Stakeholder risk is a subset of business risk representing the potential failure to maximize wealth due to inadequate understanding of stakeholder impact on the business. Now, let's think about a company like, say, MACD. Let's go back to the same example. I think customers are a key stakeholder for a company like MACD. Now, imagine that the customers have been used to eating a certain type of taste for MACD in India, and India as a market overall, in terms of non-veg food at least, favors chicken and fish maybe, and not so much of beef and pork. Now, just in order to revamp its menu, and by looking at what its counterparts in other countries are doing, MACD India launches burgers with beef and pork. Now, from religious sentiment angles, from overall consumption pattern angles, Indian consumers probably don't favor beef and pork in the same proportion in which they favor chicken and mutton and fish. And there is the religious angle also involved. So if that happens, if MACD introduces beef burgers and pork burgers, there will be an outcry or a lashback on account of the fact that two religious groups will have a problem with the introduction of these flavors, so they will stop consuming any product from this particular company, and that will also impact the sale of its existing veg burgers, which was selling pretty well till now. So under the thought process of trying out something new, under the thought process of being innovative, the company created a bigger problem for itself, because they ventured into beef and pork, which was not acceptable to the Indian consumer base. So you did not understand the stakeholders. You did not understand their needs, their expectations, their psychology, which is why you did not take into consideration how they would react to this new change of menu. And that lead to a steep decline in sale, leading to an overall impact on the wealth generation. So that is stakeholder risk. So potential failure to maximize wealth due to inadequate understanding of the stakeholder impact on business. You as an entity, MACD was importing potatoes from a particular set of supplier of potatoes or farmers in West Bengal. Now the political condition in West Bengal became unstable, and movement of vehicles has been suspended. And now, because the primary supplier of raw material potatoes was in Bengal, and now that supply of raw material has been hit, the company finds itself in a position where it does not have potatoes for making the burgers, and that happens to be a key ingredient in the burger that is sold by MACD. Now, because they cannot source it from West Bengal, they will have to buy it elsewhere, and the prices are likely to be pretty high because of the ongoing, restriction of movement that has been imposed because of the political crisis. So in this case, MACD did not understand the significant impact that suppliers in West Bengal could have on its burger business, and now it faces a situation of steeply rising cost, which has the potential to impair your overall wealth generation. So that is basically what stakeholder risk is all about. Effective stakeholder risk management requires directors to identify all stakeholders, assess their interest levels and power dynamics, and incorporate this analysis into strategic development. So you need to understand your stakeholders, what are their expectations, what is their psychology, and how to make sure that they are not dissatisfied at the end of it. For understanding stakeholders in detail, the Mendelow's matrix framework actually helps you to classify stakeholders into different categories. And then, after dividing the stakeholders into four broad categories, you can have four different approaches for four different categories and thereby deal with stakeholders in a better way, thereby minimizing any adverse impact on the wealth creation objective. What you need to understand is the power of the shareholders, their ability to influence strategic objectives. Can they have a say in how the decisions are made? Then the interest of the stakeholders. Interest here is stakeholders' willingness to contribute or impact the decision making process. I might be an 80% shareholder in some company, but I don't really care how the company carries on its objectives. I have appointed some directors to run the show on my behalf, and they are doing that. I don't care about what happens in the company on a day to day basis. So while I have the ability to influence decisions, I'm not particularly interested in doing that. And then you also have a discussion on influence, the combined impact of power and interest determining strategic importance. Not only is it about the ability and the willingness, it is about how people perceive you and what importance do they give you, and how strongly can you drive the overall decision making in the company. Okay, now basically, all stakeholders can be divided into four quadrants. Key players, these are those players who have a high interest and high power in the company. They have the ability to influence decisions and they are also interested in influencing the decisions. Then you have those stakeholders which require minimal effort. Here, their level of interest in the company is also low, and they don't really have that much power in making decisions. Maybe their percentage shareholding, their sphere of influence is less. See, these stakeholders can be, ignored or they can be put on the back burner, but you need to be aware of their requirements just because, their status can change unexpectedly. We'll look at an example to understand how this works. Then we have those shareholders who have low power, that is, they cannot necessarily have an impact on decision making, but they are heavily interested in the overall functioning of the company. They should be informed about all critical decisions. Complete disclosure is required. And then you have those shareholders who have a high power. Okay. That means maybe their percentage shareholding, if they are shareholders, their percentage shareholding is high, but their overall level of interest in the company is pretty low. So they are like, sleeping dogs or sleeping lions. You keep them satisfied. Don't unnecessarily provoke them, because if they get provoked, they might take certain decisions which might put the company in a jeopardy. So, to understand how the stakeholder analysis is done, I want us to take the example of Reliance Jio. Now, when Jio was launched in the year 2016, I think it was a huge shock to the entire market. In many ways, I would call it the hub of disruption. I haven't seen anything as disruptive as Jio, because they virtually made all calls free. Till then, I remember those times. We are talking about pre 2016 times. When you wanted to make a call, you had to, and you were, you wanted to make a call from one state to another in India, you had to get a roaming pack, and, you had to, add on additional 128 rupees. For example, you add a pack of 128 and then you would get 10,000 minutes free, something like this. So calling was still it was still dependent on the prices, and the higher the price, the higher the duration of the call, the longer the distance of the call, the more difficult it would be for you, and the more costly it would be for you to place a call from one individual to another. Internet also was expensive. I remember we used to get like a net pack of 1 GB, and in that 1 GB net pack, we would try to navigate the entire month, because internet was very expensive. That 1 GB net pack only would be for some 300 rupees. Cut to 2025, internet is virtually free. You pay a certain amount every month, 250 rupees, and you get as many GBs as you want. There's no upper limit. All of this was made possible because of Geo. ठीक है, it revolutionized the entire voice calls and ultra cheap data services. Nothing like that had ever happened before. Before Geo came, you had a lot of other small telecom operators like Uninor, you had Aircell, you had Hutch, you had Tata Docomo, you had so many. And now, because of the way Geo penetrated the market, they literally drove everyone out. And today it's a very different telecom market that we have in India. In case of this Geo scenario, I think the Telecom Regulatory Authority of India was a high power, high interest stakeholder. See, your you can operate a telecom business successfully only when you get permissions from the Telecom Regulatory Authority of India. So they have the success of your business depends wholly and solely on the permissions granted by this authority. So they had high power. And Telecom Regulatory Authority of India also had its own objective where they wanted the telecom and internet network in India to deeply penetrate the length and breadth of the country. So they had a high interest in this project also. And if Reliance Jio were to become successful, all the tariffs and the fees would be going to TRAI. So they had high interest in this particular project, which is why for the Reliance Jio project, I think Telecom Regulatory Authority of India was a key player. They had high interest and they had high power. You had to keep them super duper satisfied and you literally had to dance to their tunes because if they are happy, they will let the project succeed. And that is why these were key players requiring close attention, close management to their requirements. Okay. And at that time, you had quite a few other players in the market, but Bharti Airtel, Vodafone, Idea Cellular, they also possessed a substantial market share, and suddenly their very survival was threatened because Jio came into the market. I remember Bharti Airtel filing cases and other operators also filing cases and pushing Jio into the corner because they thought that Jio was making use of its dominant position on account of the fact that it is Reliance itself. It was making use of its infrastructure and its massive position to gain a competitive edge over other competitors, and they were not allowing a fair development of competition in the market. I think that was also one of the complaints filed. But then, of course, all these cases failed, and Jio continued to thrive. And today, you have only three players primarily in the telecom sector. The government of India, on the other hand, was a high power but low interest stakeholder, which needed to be kept satisfied. See, the central government maintained significant influence over spectrum allocation, telecom policy, and infra development. However, their interests remained strategically focused rather than operationally intensive. The Telecom Regulatory Authority of India was getting into your nitty gritties and finer nuances and the detailed aspects of your work. But the government of India, by the way, at this time, the previous government, the UPA government, had been accused of the 2G spectrum allocation scam. So the next government, which was the NDA government, they wanted to make sure that the telecom infrastructure development happens, but their names are not dragged through the mud for whatever reason. So these were those stakeholders who needed to be kept satisfied. They had high power. The government of India had high power because the allocation of the 2G spectrum, allocation of 4G spectrum was in their hands. But they were not particularly interested in the day-to-day running. As long as the strategic objective of the government was getting fulfilled, they were not really interested in the day-to-day operations. So you had to keep them satisfied. But unlike the previous stakeholder, which was the Telecom Regulatory Authority of India, they were key players. Government of India, on the whole, or the state governments, they were important stakeholders who needed to be kept satisfied, but you did not have to dance to their tunes. Okay. Then you had the low power but high interest set of stakeholders, which was your consumers. See, consumers like you and me, we are not very loyal as consumers when it comes to this segment. Anyone who is willing to give us data for free and anyone who is giving us calling services for free, we are going to flock to that service provider. I know so many friends of mine who dropped their existing networks and shifted to Geo. So millions of these new data users who had a high interest in the company, they did not have so much power because they were individual shareholder, they were individual consumers operating in isolation who just wanted as much service as is possible. But They did not have any ability to influence the policies, but they were the ones, who had the highest level of interest, I would say. So what Reliance Jio had to do was it had to structure its marketing campaigns accordingly. It had to keep the database engaged. It had to keep the consumer base engaged. And how would they do it? By, offering some promotion, by giving some promotional offers. Uh, you know, by giving promotional offers, or by giving some free gifts, or by giving some additional free months of usage. So all of these were techniques that they were employing in order to keep the customers connected with the company. See, in any market, out of sight is practically out of mind. So you cannot afford your consumers forgetting you. So you had to keep on enticing themselves, you had to keep on engaging themselves with tools, promotional offers, advertisements, free gifts, free data, and whatnot. And that is how, Reliance Jio was able to keep all the customers with it by constantly engaging the consumer base. And of course, the low bar, low interest operational stakeholders. Who were these operational stakeholders? See, when a project like Geo goes live, I think the length and breadth of the country is impacted. And in different areas, you will need people to set up the telecom towers for you. You will need people to do the electrical repairing and maintenance work. You will need teams of engineers. You will need vendors. You will need equipment manufacturers. Now, see, for someone who is, who is an electrician, a project from Geo and a project from someone else is practically the same. You are still going to get paid the same amount. Okay. Or think about it. For someone like, for an engineer, a project from Reliance Jio, a project from Siemens, a project from L&T is going to give him the same level of remuneration. So these are stakeholders who have low interest and low power in the company. You have to take minimal effort for keeping them satisfied. You don't have to put in too much effort for these stakeholders. And from an overall stakeholder management perspective, the first step was to classify the stakeholders into right categories and then come up with the correct approach to engaging with them, keeping them satisfied, and ensuring that they do not act as a roadblock for the company in achievement of its objectives. So that was the long and short of the analysis on stakeholders and the Mendelow's matrix. The Mendelow's matrix is not just an academic topic, but it has wide-ranging applications. It helps you to assess the It helps you to come up with a strategy for alignment of interest of stakeholders. It helps you to identify who is on your side, who is not on your side. How do you make sure that the stakeholders are happy? Which are the stakeholders who deserve the least of your attention? But the problem is sometimes it's very difficult to classify stakeholders into one of these quadrants. It is very difficult to identify who has how much interest and who has how much power. And depending on the changing circumstances, a stakeholder who is in the minimal effort category might become a key player in the future. So it's not a static analysis, but it is an ever evolving analysis. And sometimes the ethical considerations might be overlooked in an attempt to keep the stakeholders happy. Now, in any organization, you have internal stakeholders, that is, people who are within the organization and who are getting or who are in touch with the organization on a daily basis. This includes directors of the company. They are the ones who are running the show. They have high power and high interest in the company. And to keep them happy, see, directors are running the show. So you need them to be happy. You need them to be satisfied, because only when that is the case, they will help the company reach its intended position. And you also have employees. Who are these employees? These are people, who are reporting to the managers, to the directors, but they are the actual hands and the executors of different activities in the company. And if you don't pay them an adequate compensation, if you don't hear their requirements, and if you do not give them proper working conditions, they might get dissatisfied. They might leave the organization. If you have a union of these employees, they might disrupt work. So again, these stakeholders have to be dealt with a lot of care and caution. Then you have your connected stakeholders, those who are linked to the organization through some sort of a contractual relationship. Now, be it shareholders, customers, suppliers, creditors, all of them are connected with the company through a contractual relationship. A creditor has sold goods to the company on credit, and see, if the company fails, he will not get his money back. So he is most concerned about your financial well-being, because only when the company is running well will he get paid for his dues. And that is why if anybody is your well-wisher, I think it is your creditor. Then your customers, these customers, they might be addicted to your product because they have been using it for years, or they are the key drivers of your business. Your success depends on satisfaction of these customers, so they also are very critical to the entire stakeholder analysis and the overall achievement of objectives. Shareholders are the owners, and then of course suppliers and creditors are equally important. External stakeholders are people outside the organization, but who have a broad influence on how the organization functions. The regulatory bodies, the government of India, the auditors, the trade unions, the environmental support groups, the peer pressure groups, all of these are external stakeholders, and they will have an impact on how the organization is functioning. So you cannot afford to ignore them. The trade unions have the capacity to come together, stage a demonstration, stage a protest, and bring your production to a grinding halt. So you cannot mess with the trade unions in any way. And for the overall growth of the company, the stakeholder theory basically tells you that you should first of all focus on mapping the stakeholders into different categories, then do the par interest assessment, see what strategy works best for them, and then make sure that you monitor the stakeholders, because it is quite possible that a stakeholder in one category, a minimal effort stakeholder, might become a key player because of change of circumstances, and you don't want to be caught off guard. So you have to ensure that you keep on monitoring the performance of these stakeholders, monitoring the expectations of these stakeholders, so that if the classification changes in the future, you take the right effort to uh, serve them in a way that they desire. This discussion of stakeholder theory, again, as I said, is very important from an examination perspective and even in your practical life. When we start doing the questions, you will realize how critical was this discussion to the overall SBL paper.